How's it going? My name is Chris Gassel with USA Mortgage. I am presenting you this video today because I wanted to create something that would show the pros and cons of renting versus owning a home. I put together a very detailed sheet using a tool called Mortgage Coach to show you guys all the ins and outs of buying a home, closing costs, fees, cash to close, mortgage insurance, FHA, loan, everything that you could think of when it comes to weighing the options of do I continue renting or do I need to go out and finally buy a home and see what the true benefits are financially for myself. So I hope you find this video very informational and helpful. And if you ever need anything, my contact information is going to be at the end of the video, and I'll put links below as well. Thanks, and I hope to talk to you soon. Hey everyone, it's Chris Gassel with USA Mortgage. I wanted to do a quick little video here and show you some awesome new technology tools that we have in regards to loan comparisons, comparing renting versus owning, just comparing loans in general if you're even thinking about buying a place or refinancing too. It's a really great option to show you kind of all the ins and outs of the loan process, the potential savings, and just kind of overall ways to make a better financial decision when you make such a huge purchase in your life. So for this instance, I just did a quick rent to own kind of comparison just to show you kind of what renting is versus owning a home. So my basis was I just used rent. The rent is actually $1,100, but for full apples to apples comparison with escrowing taxes and insurance in the house, I rolled in the monthly mortgage insurance or monthly renter's insurance as well, which is generally about 20 bucks a month, 15 bucks a month. It's pretty cheap. So rent of $1,120 versus these payments. I did everything under the assumption of a $200,000 purchase price. We did 3.5% down FHA, we did 3% down conventional, 5% down, and 20% down. Obviously there's VA, USDA, all those kinds of things. But what it comes down to is I just wanted to give a quick little show as to what this tool could do. So there's rates in here which are not accurate. I just kind of plugged in a bunch of random stuff. The APR, I did plug in a bunch of closing costs to show you kind of how it calculates the APR, so that way you kind of know what you're buying. Although I feel like this one is a little high because there's something amiss here, but what it comes down to is this program really shows you in full detail the financial analysis of comparing these programs and the benefits of renting versus owning. So one of the cool things I want to kind of get into is as you kind of go in, it's fully interactive when I can email this to you. You can sit here and view the price of the house, the principal and interest payments, the property taxes, monthly escrowing, the hazard insurance monthly we're escrowing, and mortgage insurance if it's even applicable. Like obviously with 20% down, it's not. So the other thing is it gives you the full monthly payment. And obviously if this was an investment property and things like that, it would show you kind of the benefits of investing with rental income versus the actual mortgage payment and what the actual total payments would be. It also gives you a little bit of a breakdown as to the percentages of the payment itself versus the escrowing. So the principal and interest and the mortgage insurance on this one are about $1,087, and then the escrows, which all of these will be the same, are about $350 a month of your payment. Because escrowing, as you know, can obviously go up or down. Your insurance can go up, your taxes can go up, or those things could also be reduced. So it's really one of those things where it's nice to see it broken out by the actual loan itself versus the escrows too, because at the end of the day you want to know what this total monthly payment is, but you want to know what the actual principal and interest stuff is, where it's going to have the most impact on your finances and the actual ownership at the end of the day when you make payments towards principal and interest. Closing costs, I went in here and I just did a quick little detail sheet. You can see the APR cost versus the non-APR cost. Again, I think that other one's a little higher because you can see these APR costs are kind of all the same for the most part. And then you've got upfront mortgage insurance, like FHA has the 1.75%, obviously, which makes this loan to value higher than 96.5 because that is being financed in this case. And that is actually an APR cost as well. So we get $1,000 earnest money, but here's also what's kind of cool. So I actually can go in here and I can show you, a rough estimate of what a loan estimate would look like with actual fees that we charge. So, we've got our lender fees up here at the top, the $1,200. We've got the appraisal, we've got credit, we've got guesstimates on title, recording fees, insurance for escrowing, and insurance for taxes. And then this is the actual premium being paid at closing. So that way you can know for a fact kind of what all is actually being paid in this process. And you can see on all these other loans, it's all the same. I use the same fees and sheets for everything else, just because it was kind of basing off that $200,000 purchase price. And then down here you can see the total difference in the cash you would need to close. Now this includes the down payment and it includes the closing costs listed up above. So you can see obviously 20% down, you're going to need a little bit more equity, but this just shows you like on a $200,000 home, with total closing costs, you're looking at about $10,823 on a 3% down. But this also really doesn't equate any kind of seller credits or contributions in that regard, or lender credits for that matter either. So, I mean, it is possible to put an offer on a home and get a credit that will pay for all of those closing costs, and in which case you would only be stuck paying the $6,000 down payment, which, that could be a gift, that could be a grant, through down payment assistance stuff. There's a lot of cool things you could do here to where you would qualify for the loan. The reinvestment one, this one is more just to show you kind of the monthly savings that you would actually have versus each loan. So obviously the more you put down on a conventional loan, the more savings you're going to have. But the reason why this screen really exists is because down here, I actually put in the estimated savings account that this person would have, and you can see also up above here it tells you when the mortgage insurance would be cut off. And the reason why I think that APR is off is this isn't 30 years; it's a lot sooner than that. But you can see the $15,000 versus the cash to close, and this is kind of what would be left in their account at the end of the day. And we just used 0.5% as a savings return rate. Some people get 1, some people get 2, some people get half. It kind of depends on where you bank and where your money's being held. But it also shows you if you were to keep this money in here over a 5-year period, you can see we got the 5 years right here. This is how much would actually accumulate from 3182 the day after closing to the 5 years after the fact at 0.5% interest rate. So it just really shows you your money's really not making any money at all in a savings account. That's really what this is meant to show you. It's meant to show you kind of more the use of your funds. So on that note, let's kind of go down here and we'll talk about these monthly payments. So you can see really the clearly defined terms, 360 months, which is 30 years. 30-year fixed is what we used here. The closing cost and the down payments versus the total cash to close and the interest rates. And then as you go down, you can see the rent that you would pay versus the actual principal you would pay. And I used a 12-month period simply because I think that when it comes to comparing renting versus home ownership, most rent leases are only about a year long. So I think it's only fair to just show the savings over a year for this kind of comparison. So under that current structure of $1,100 a month plus the rental insurance, so it's $1,120 a month in rent payment. You got $13,440 that you're paying in rent for that 12-month period. Obviously, you're going to pay a little bit more if you just do 3.5% down or 3% down because you are going to have a little bit of a higher payment, but you're also going to have that ownership of that home, which is going to equate to equity. So as you can see down here, you can see the total equity versus renting. Obviously, with renting, you're not building anything; you're just paying a landlord money, and that money is not going to anything other than just really a place to live. As opposed to paying for this home, you put 3.5% down into the house, and then you've got the payments that you've done, which reduces that the loan balance. So at the end of the day, we're also it should show on here, but this is equating a 3% equity raise. But I also did a 3% raise for appreciation for the taxes for the tax benefit. So to kind of really wash those things out. So even if you kept this at $200,000. You're still at $7,000 in equity versus 0 on a 3.5% down loan, or in this case too, you're talking about $9,000 versus $0. So it's really meant to show you the benefits of owning a home with that equity that you can actually make. And then one last one. Just shows you kind of that net worth of 5 years down the road. Obviously, we don't want you paying rent for 5 years because, look at that number. That would be astronomical. And that assumes a 3% increase in rent, each year over year. And then you can kind of see the total payments that you actually make. It starts to close that gap a little bit. But that equity really, really increases. Now, this property appreciation rate in 5 years is probably a little unrealistic. I think I would probably more tone this down to 1.5% for your actual presentation, because I think that's a little bit more realistic. The rental increase, though, I mean, based on things in our market that we've seen, 3% is not actually far off from rental increases, but it also depends on where you live. You know, some places don't increase at all, and some places only go up $50 a month. So what it comes down to really is just showing the idea that paying rent versus paying principal and interest and the tax benefits, the net costs, the value of your home increasing, the equity that you have increasing. I mean, if you think in 5 years that you could have 50 grand in equity versus $70,000 in rent, I mean, just think about the difference alone of $20,000 away that was not thrown away. I mean, that's $50,000 in equity that you would have access to, you know, if you needed to sell the home, if you needed to do a home equity line. There's a lot of ways you could do to get access to that equity. And it's just one of those things where I want to highlight kind of all the pros and cons to both. So, you know, if the rent was obviously a little bit smaller, like if this rent was only $700 a month, you would see through this sheet pretty clearly that renting in your case versus buying this home, if your goal was to have a lower monthly payment, then renting is really the best option for you. So I just want to kind of showcase that. So if you're interested in just kind of seeing loan options, payment breakdowns, anything like that, you've been house shopping, this is a really cool tool that we can use. And it's not just for renting, like I said, it's also for refinances, it's for purchases. It's really to show you kind of all the options available to you so you make the right decision at the right times when you go to purchase your home. So again, my name is Chris Gassel with USA Mortgage, and I look forward to helping you in the near future. Thanks.